Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss the federal meetings.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
We're up 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us.
Pennies.
Going in raw.
Featuring Dan, Deity of Dips,
And Hugh Henny.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Wednesday, March the 16th, and the big Fed meeting's coming up tomorrow. You had kind of a little low volume heading into it, a little meltdown on Monday, but you're seeing that pop up on Tuesday. Back up to like that 426, 427 range on SPY. What are you kind of thinking about that? I mean, to me, it was kind of obvious on Monday that it's like a somebody knows something tape almost. What do you think about that? And do you think maybe it's a sign that maybe the Fed could be good?
So I don't want to speculate too much, even though I have, and that's kind of my job. But I think that I went into this week thinking that most of the noise or most of the action leading up to the Fed would be noise. I thought that we would have the big range, which we have. Monday we what was it? Monday we opened up 1% and ended the day down 1%. And Tuesday we opened up a little bit, tested, almost went red, and then ended the day up 2+%. So realistically, though, when you take those numbers, it's really only like the market's moved like a percentage point from where it opened on Monday, even though it's made like a 6% point move intradays. So I do still think that most of this is all noise, and that it all comes down to what the Fed says. Wednesday. Now we've talked about the Fed a lot. But we figured that this would be a really good episode to go over an overall generalization of the Fed, but also a little bit more about like why this meeting is so important, because we've touched on it a lot inside the past few weeks. But I just want to make it as blatantly obvious as possible and just not beat around the bush and not just touch on it.
Yeah, because we always talk about it and we always make it sound like there's big bad things coming. But I mean, when you look at it, I mean, you have 8 a year. So, I mean, there's a good bit, but I mean, some people may not even know what we mean by when we just say Fed. So I think kind of going into it, what these basis points are, kind of getting the jargon out of the way first. And then, so I think going over first, like, what are the federal meetings and why do they have them, and what exactly does the market react to it due to?
So first off, these federal meetings are basically, the Fed is a separate entity, and they're basically supposed to keep the market in check. And so basically, they're supposed to be kind of like a seesaw against the economy. We've talked about this in the past, but again, we want to be redundant inside this episode. So, strong economy the Fed kind of pulls off and weans off, and probably, if the economy is extremely strong, then they're going to try and slow it down so that we want to keep our growth in check, which kind of sounds like that kind of sounds counterproductive, because why wouldn't you want, super high growth? But, the one thing that you don't want is that you don't want the economy growing by like some crazy percentage points. And because at the end of the day, you would create such a big supply and demand issue. And so when the economy's good, the Fed tries to slow it down a little bit or keep it in check. I'll just say keep it in check. And then on the flip side, when the economy is, let's take Corona. When the economy is suffering hard, the Fed steps in to I don't want to say to keep the economy going, but in a certain sense, it is. Basically what they're supposed to do is that when the economy's bad, it's supposed to be enticing for people to go out and spend money, consumer spending, little things like that. Like, you want to keep, the whole point of the economy is to keep money flowing in and out and around. And so that's pretty much what they do. It's a constant seesaw. They're on the other side of wherever the economy is, or where it's headed. And so that's really like where the Fed acts. Now, if we take 2008, there's a few really good movies on 2008, but I kind of consider tomorrow, because we're recording this on Tuesday, I kind of consider March 16th, and what they do with the rates similar to when Paulson asked Congress for a quote unquote bazooka, or the blank check. And for anybody that doesn't know what I'm talking about, this is when Lehman Brothers and some of the banks started to collapse. The government stepped in and held those banks up. Warren Buffett too. Warren Buffett single-handedly held up B of A, and he profited well from it. But so that was a perfect example of, hey, listen, banks were going to start dropping like hot flies. They already had started a run on, but if they hadn't basically give Paulson this blank check, then the uncertainty inside the market could have continued. And
just one thing is either dropping like hot cakes or dropping like flies. It's not dropping like hot flies.
I don't know. We're combining both. Don't they both mean the same thing?
I mean, yeah, they mean the same thing, but when are flies necessarily heated?
I don't know. Maybe aren't they mammals? Aren't mammals all warm-blooded?
Jesus Christ, dude. That's crazy. You know what a mammal... No, that's wild. That's crazy, dude. Anyways, about this blank check, man. I think we need to get back to where you were, because things were dropping like flies real quick here.
Yeah, hot flies.
Flies.
So I think it's important to note that, that was a pretty big deal at the time. And this isn't necessarily like that's where we're at, because, there's not tons of panic ensuing. But the way that the market acted on Tuesday, to Dan's point, it was kind of like the market was really bullish going into Wednesday's meeting. And I mean, when we think about it, if we're running into an event like this, there's two ways that this happens. Either it's priced in, and everything's priced in, and because it's not just one thing anymore. It's the supply chain issues, high inflation, defending the dollar, World War III. I mean, there's just so many things, and so it either means that we've priced all of that in. And Wednesday can't hurt us necessarily, unless something completely unexpected happens, or we ran into it to sell the news. And I think that all of that depends on how much we raise rates. Now, getting back to the Fed, as I was talking about, I do consider this to be a pretty important meeting and a pretty important announcement because rates have been super low for like most of Dan and I's adulthood now. Money's been cheap to borrow.
Hasn't been long for you.
Well, yeah, but man, I'm almost 24, bro. Like we were talking about, the Fed is basically, keeps everything checks and balances. So when you raise interest rates, you're making money more expensive to borrow. Now, on a super elementary level, okay, when I want to borrow money, I'm going to have to pay, a certain percentage on that. Now, let's just say that right now you want to borrow $100,000, it might be at like a 12% interest rate. Yeah, I'm just throwing out numbers here. When interest rates are raised, that baseline that would usually be 12% raises to 15, 16%. Now, typically you do this when the economy is strong or stronger. Now, how much you raise rates depends on where the economy is at. Now, we are at the lowest. We are literally like money's never been cheaper than right now. But the interesting thing, and one of the things that is important to note, is that we're not raising interest rates because the economy is necessarily strong. That's not what this is. We're raising interest rates, and I've been working up to this analogy, is that effectively over the last 20 months, the market and the economy has been held up by the Fed. We talked about in last week's episode, the Fed has put more money into the market in the last 16 months than inside its entire existence. Now, the analogy that I'm using, and if you want to say it's a good one, you can, because I think it's a good one. The way that I look at this is that effectively what we're doing right now is that we are on a Japanese bullet train going 100 miles an hour, and the Japanese bullet train being the economy, and the speed being the conductor being the Fed.
Naturally.
Naturally. We're going 100 miles an hour, and we need to slow down to like 60, ideally like 50. That's inflation. So we need to slow her down. Now,
how long have you been thinking about this analogy?
A long time, honestly. It's been a working theory for a pretty long time. I'm gonna be honest.
Okay.
I'm pretty proud of it. So if somebody calls it stupid, or if you really want to make my day and you want to say that it was great underneath my Twitter, I would I might be happy about it. But so effectively, to get this train to slow down, you use the brakes, which would be raising interest rates and stop buying. The Fed stop pumping money into the market. Now, if you push on the brakes too quickly or too hard, raise interest rates too much, then effectively the brakes are going to break off. The train goes off the tracks, and we go into a recession.
Oh no,
that's the one scenario. But you have to slow down the train, so you just can't tap the brakes. So effectively, what we're trying to do right now is that we're trying to U-turn this bullet train, effectively yet very touchy. I'm looking for a nice word like sensual. What's the word I'm looking for? Like give me a synonym.
Tender.
What?
Tender? I don't know. What?
No, like we're being smooth about it, like we're making love, it's nice. It's
sensual works there, yeah.
Yeah, all right, that works. So we're trying to be like sweet to her, like we're just tapping the brakes, okay? Because again, we tap them too hard and they break off and we go into recession. So, in my opinion, with everything that's going on, right, and again, the economy is still inside like the economy is still somewhat in the gutter. Like let's not act like we have major supply chain issues. Oil was at $130 a barrel. It didn't hit 150. I still stand by my that it won't hit 150 or 200. I still stand by that prediction. And so I believe that 25 basis points is basically priced into the market. I still think 50 basis points would be too much. But I think that 25 basis points is priced into the market. Now, if we saw 75 or 100, that's where like the brakes that's where like the brakes break off and the train goes off the track. So I'll be looking for like 25 basis points. Now, if it's 25 basis points, I'm not like, all right, market goes back to all-time highs. I don't think that. But that's a good way because similar to inflation, when it gets started, it's like a truck rolling down a hill on fire with no brakes. Very hard to stop. But when you, similar to, inflation running, once you start to curve it, it's again the same thing. Once you start to curve it, it's slow and it's gradual, but you can bring inflation down. Okay. So what I'm saying is that you really just need like that first domino. Now, again, we're being very sensual. So we're just giving her a little half flick of the domino. Okay. We really don't.
I thought you meant a totally different half flick.
No.
we were saying sensual. No, keep going, man. My bad.
So we want to lightly tap the brakes with a 25 basis point raise. That to me would be great. Now overall, okay, obviously Russia and Ukraine have their issues and they're inside peace talks. Now, in an ideal world, they figure out a withdrawal of troops, and they actually sit down. And have a discussion without any like actual firing. And then an oil deal would be nice too. That would be, kind of like the cherry on top. And then a 25 basis point raise. And then the next time that we have an inflation update, it's lower. That is like, that would be perfect. And it comes back to, the hang set. Oh, I'm fucking that up. But basically every other world market has gotten smoked. And we're really only 13% off highs. Now, individual names have gotten killed. I totally get that. But, like the bigger names really only 13% off highs. And so inside an ideal world, like I said, we raised 25 basis points. I don't even think it's actually out of the question that we don't raise rates at all. Like that's not necessarily like, I don't think that that's out of the question because again, the economy is still in shambles. You really only want to raise rates when the economy starts to be strong again. And I mean, right now there's more uncertainty than, honestly, like probably 2 years, like March, like, no, that's not true. Not peak COVID, but probably within the last 15 months, this is the height of uncertainty with everything that we have going on with supply chain issues, Ukraine, Russia, like to me, that all of those are important. But again, you got to stop inflation. So this is where like that seesaw touch and go gas brake comes into play. So all that being said, 25 basis points to me would be pretty bullish because I see that as priced in. I don't think it's out of the question that maybe they don't raise rates. In addition to that, Ukraine and Russia peace talks would be fantastic. That would be like a little cherry on top. And then an oil deal with Russia would be great too. Because here's the thing is that right now, again, some of the uncertainty, which we didn't even touch on, deals with China. Like we can cut off Russia. We can't cut off China. We're too intertwined with China, excuse me. And so, but if Russia and Ukraine fix their tensions, then tensions between China and America would definitely ease as well. So it's kind of like one of those like the tide lifts all boats. That's kind of how this is right now. So in my opinion, that's kind of what I'm looking for. It won't be anything crazy because with these kind of bigger economic events, the market needs to digest itself. So this won't be like, we're saved. This is more like, hey, let's not get a 75 basis point raise and go into a recession. That's what I'm basically trying to say here. Because a 75, 100 basis points, that I'd probably be selling my retirement accounts or majority of them and having cash on the sideline. Oh, also the other thing is that the press conference, when Powell speaks after, that to me is also important, because it's one thing when you have this is what the Fed's going to do. It's like they use the same press releases for everything. The Fed announced today that they are going to blank. But what matters is when they step up to the podium and they talk about it. So if we only raise 25 basis points, but then they come up to the podium and they say, hey, by July, we want to go up to 100. That's doing the same damn thing. Okay, so the one thing to be cognizant of is that it does matter what they say at the podium. Now, I'm not saying that that their word is gold, because we know how that works with politics and stuff. But we just don't want them to spook the market. That's going to be the biggest thing, because and this goes for companies with earnings too. Just a little sidetrack here. If they have a good quarter, great. But if they have bad guidance, oh my God, they're going to get smoked. So it's the same thing with the economy. If we raise 25 basis points, fantastic. Okay, great. But if we say that we need to raise 100 in 3 months, or next quarter, or by October, that's effectively going to spook the markets. So honestly, probably just watch stuff. Honestly, all day, probably. If you want to take a trade off open, fine. But I would just watch. I would just pretty much stay out of the market and just watch, because like I said, this is a significant event and there's too many things that can happen. In trading, you want to take out the variables. It's all about taking out the variables and mitigating your risk. Yeah, they could say 25 basis points, or that they're not going to raise rates, and that would be super bullish for the market. But at the same time, if they say that they're going to raise 50 basis points, or even 25 basis points, and then they come to the podium and they start talking, if inflation gets any higher, we're going to have to get more aggressive. This is kind of, although we didn't raise this month, although we didn't raise at this meeting, next meeting we expect to do 3x. You know what I mean? That's effectively the same thing. So I would just stay out. Hell, even stay out for the rest of the week. Just let the market digest this stuff. You'll feel when there's a bidder in the market, like there was Tuesday. You look at the 5-minute chart, there's a bidder in the market. Now, that bid can be pulled at any time, which is important to note, okay? The bid can be pulled at any time. This could be a bidding up to slam it down kind of thing. But if you start to see that bid coming in and we start getting over 440, we're climbing to 450, you're seeing underlying names get bid up. And so I'm saying the names are down 50, 60% that have good fundamentals, and these companies were trading 50, these companies shouldn't necessarily be down here. That's when again, I'm still bullish on the market. Okay. I still have my SPY calls, I'm still buying dips, and selling rips, but tomorrow will definitely change my thesis. But overall, I'm still bullish on the market. I still think the market sees all-time highs before it sees, I don't even know. You can throw out any number that's down, more. But again, is that if tomorrow 75 basis points or 50 basis points, that might change my thesis. But inside the current thesis, I'm still super bullish on the market. It's March 15th, 16th, whatever.
Yeah, I remember on Monday I bought some 426 calls for Friday when it was 417. They were cheap. Sold them before they were in the money today for 50% gain. I didn't want to lose that at the risk of Fed being awful. So, and this next part, just to dumb down as you can, would you give the basis points for dummies? You keep saying the 25s and all that. What, when else are we going to hear about basis points? Where do these basis points apply to? And where's a good place to kind of get all this figured out?
Yeah, so it's a Fed interest rate, okay? And so when we say, most people inside the industry say BIPS, BPS, okay? And that's basis points. When we look at a percentage, it's like 25 basis points would be 0.25%. 100 basis points would be 1. You know what I mean? Like, and the ideal goal will be, just one last thing. The ideal goal will be to get inflation honestly underneath like 4%. Really, we need underneath like 3% to really be inside the clear. But when I'm looking at this shit, like that's a long way away. We talked about it, earlier inside the episode. That's that although once you start to curve it, it starts to, go down pretty, I don't want to say easily, but once you curve it, that's usually the peak. But it takes a long time to get it back down there. So that's why I say that like this will probably be the cheapest money for probably at bare minimum the next 5 to 10 years. And just like I was just saying is that genuinely, genuinely, you don't want rising interest rates because, well, I'm talking purely from like the stock market standpoint because companies, borrow money. Like every company borrows money. Every company. So that, digs into it, especially if you're dealing with like a few $1 billion company. You're dealing with a few $1 billion company, those few basis points add up quickly. And, they can be the difference of like tens of millions of dollars. So, that usually plays a part into it. And that's why we genuinely don't like to see it. Now, if we were inside like a super strong economy, it might not affect it as much. But again, we're inside, like it really feels like there's so much uncertainty right now, but we have to raise rates to control inflation. So we're really put ourselves inside a pickle here, which is why like even though I'm bullish on the market, it's basically like we're down bad and we could potentially be getting our, kicked in the face. If they raise interest rates, 75 basis points. And then the other thing is that usually you see, and this is just like a little tidbit. Usually see bonds fall with rising interest rates. So if you're holding your bonds, maybe you get rid of maybe you want to sell some. Now I'm not a huge fan of bonds in general, but typically that's what happens. And then the last thing that we'll touch on is that. I've mentioned a few times that I have a small position in gold. Like they're literally like gold coins. Gold is over 2,000 now. So my position's up like 17%. It's literally physical gold. There was a few people that when I had mentioned it last year had followed me into it and bought a few gold coins. It's nothing, it's not a big percentage of my net worth, just a few percentage points. Over 2,200, I'll start to unwind those gold coins, and closer to 2,500, I'll probably sell them all. I started buying underneath 1,800. They get to 2,200. It's a pretty good return. 2,500, fantastic return, and it did its job. It was my hedge to inflation, and made me a few bucks on the side. We'll take it. And so that'll be probably what I do with gold. I don't want to get into like gold can go higher, but it did its job for me. It also made me a few bucks, and so now I can unwind the position and use that cash for other stuff. I'll hold some of it still for long term for whatever reason. But overall, I'll start to unwind that position, and over 2,200.
All right. Well, we'll be praying for everyone heading into Wednesday's Fed meeting. We'll try and drop this early on Wednesday if our editors are, doing their thing. And lastly, maybe we should make a March Madness bracket for group for PGIR listeners. I have 25 already made. I know one's gonna be perfect this year. So yeah. War Eagle guys, Auburn's going all the way. It's gonna be a blast, and I'll put a link to it, and we can all have some fun. All right, guys, we'll see you on Sunday. Y'all have a great rest of your week. Peace.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.